Our next guest says it may be time to sound the alarm on Treasuries. He's Neel Kashkari, the managing director and head of new investment initiatives at Pimco. He says American leaders must act quickly before investors lose confidence in U.S. debt. You also know him, of course, as the former top Treasury official who headed up the TARP bailout program. Good morning to you, Neel. You know, your title to this, the market flashing caution in U.S. Treasuries. Right now, we're seeing the cost of insuring U.S. Treasuries at the highest level in almost a year. When does yellow caution become flashing red to you?
Well, Margaret, good to see you. That's the question policymakers are always asking us, exactly how much time we have. And unfortunately, no one knows for sure. It could be many years from now, but confidence could also fall rapidly. Remember, confidence is not only determined by our own absolute economic strength, it's also determined by our relative economic strength. And so to the extent that our major trading partners are improving their fiscal position more quickly than we are, and by the way, that appears to be happening, confidence could fall much more quickly than we expect. Go back to the housing market. In hindsight, statistics like prices to rents, prices to income, underwriting standards, those were early indicators of problems to come. Today, many market indicators in the Treasury market are flashing caution, and our policymakers need to take that warning very seriously.
So, coming to town today, biggest, consumer of U.S. debt. We have China's president coming in here. As our economics editor pointed out to us earlier in the show, more recently, Japan has actually been inching up, China pulling back a bit in terms of appetite. Are we reading too much into, a month or two of buying habits, or when do we seriously get worried about foreign demand lessening?
Well, that's a very good question. If you look in 2008, foreign investors, both private and sovereign investors, owned about 55% of total Treasury debt outstanding. That has now fallen to 50% of debt outstanding. And to the extent that we continue to issue record levels of Treasuries year after year after year, it's inevitable that foreign buyers will begin to look elsewhere for their investment dollars. And to the extent that they do that, our borrowing costs will increase. That'll create a drag in our economic growth, and that will be part of the loss of confidence in Treasuries and in the U.S. economy. Today, and for many decades, we have benefited by having the reserve currency, by having a robust, deep, and trusted Treasury market. We need to make changes, get our fiscal house in order while we still have that confidence. If we wait until we have an acute fiscal crisis here at home, the way they're happening in Europe, that'll be too late. The damage will be done and the confidence will be lost, and it could take years or decades to be restored.
Neel, so many political forecasters said it would still take years for Congress to get to the point where they can come up with consensus to pull back spending. So, does the Fed then have to take the lead here and say, maybe we'll exit QE2 early, maybe we won't consider QE3, we'll stop purchasing debt, stop financing, in some ways, spending?
At some point, the Federal Reserve will absolutely have to do that. The reason we've had such low inflation for 20 years is because the Federal Reserve has worked very hard to develop and establish its credibility that it's going to ensure stable prices and not monetize the debt. Now they're walking a fine line with QE2, trying to slightly bump up inflation expectations, but they're also trying to preserve their credibility. If Congress doesn't act, and if the administration doesn't act, and actually passing structural reforms to bring down our deficit and make our economy more competitive, the Federal Reserve will have no choice. They will either lose credibility, in which case inflation expectations will climb, and then we could have an implicit default through a devaluing dollar and increased inflation, or the Federal Reserve will put the brakes on the economy by pulling back all of their programs. So the Federal Reserve at some point is going to have to make a hard choice if the White House and Congress is unwilling to do so.
When would you, do they need to make that choice now?
Well, I think Chairman Bernanke has been quite explicit when he testifies in front of Congress, saying they're taking short-term measures to try to make this adjustment less painful. But almost every time he speaks, he is calling on the administration and the legislature to come together to put together a long-term, serious plan to put us on a sustainable fiscal path. But remember, just putting together a plan like the Simpson-Bowles proposal is not good enough. We need to define success as actually enacting major legislative reforms that are going to make our economy more competitive and get control of our deficit spending. Planning is fine. We actually need action now.
Neel, when you were here a few months ago, when you took a look at what was happening in Europe, you said it reminded you of when you were at Treasury and watching the dominoes fall in succession. The weakest banks, tipping off the next. You saw that happening in Europe. Give me the perspective of where the U.S. is in this crisis in confidence and this newfound scrutiny of debt.
I think we're still early stages. I think we are, if you were to compare it to the housing bubble, the problems are still developing, and it's not too late for us to fix the problems without having a crisis, but we need to take it very seriously. So an analogy would be someone is setting off, waving the flag that the housing bubble is, we're starting to see signs of a housing bubble. Our debt is now starting to get away from us, and we need to make hard choices. Remember, back in 2005, when the few people were raising alarm bells, many people said, what problem are we having in the housing market? Home prices keep going higher. More Americans are participating in the American dream. What could be wrong with that? Well, we have real challenges now on the fiscal side in America. We have a terrible unemployment rate, 9.4%. We need to bring that down. As I've talked to you about before, for 30 years, our economy took on more and more debt. That fueled consumption rather than savings and investment. We need to flip that around, focus our society on savings and investment rather than consumption, and get our fiscal house in order. Again, the good news is we can look across the Atlantic and learn from what's happening in Europe and recognize that could happen here. So we have a brief window of time. We need to seize it and not let it pass us.
Neil, we've been talking about declining confidence in U.S. debt, but you're actually finding more opportunity in equities right now. The world's biggest bond fund manager getting into the equities business here.
That's right. It's a major strategic move for Pimco. We've been at it now for well over a year, have brought some world-class equity investors to Pimco, focus on global and international strategies. If you look at, in my assessment, one of Pimco's real strengths is our understanding of global markets, global risk, currencies, etc. We're taking that expertise, combining it with world-class bottom-up stock picking, and rolling out global and international strategies. So a year ago, we launched a global deep value strategy. We're now in the process of getting our emerging market strategy ready for launch and our focus on other global and international strategies. It's very exciting because we're bringing some of the best fixed income, risk management, and economic expertise together with some of the best bottom-up equity research to bring out what we think are very differentiated and compelling offerings.
So, Neil, how do we read then sort of your take on equities right now as we look at the financial sector, per se? I mean, last week we had a big move there by AIG repaying the $21 billion that it had left on the Federal Reserve credit line. Is that a limping along, or do we see that as a true return in terms of financial sector health?
Well, I think that the AIG situation is certainly much, much better than I ever expected it to be. The fact that they've repaid the Fed and are now setting up plans to eventually repay the Treasury, I think that that's a great success. It reflects the health of AIG's core business now that they've gotten rid of some of the other assets, and it reflects broadening the health of the financial system and the financial sector more broadly. I mean, if you look at bank earnings, credit quality appears to be improving. A lot of the risk capital is certainly improving, even in light of the upcoming Basel III standards. It looks like the biggest American banks are well capitalized to, or over time will be well capitalized to meet those standards. So much of the downside risk that people were fearing among the biggest financial institutions appears to be receding. Whether loans grow from here is really a broader economic question. Right. And as we've talked about before, we have a long adjustment period. But I think a lot of the downside risk in the biggest U.S. financial players is reducing, and that's a good thing.
All right. Neil, always great to talk to you. Thanks for joining us on InBusiness.